So we're focusing on, again, business income and business deduction. And the simplest type of business entity, and we'll be covering different types of entities in chapter 4. The simplest type, though, is a business that's not a corporation and it has only one owner, and that's utilizing this form called a Schedule C. And on that form, we're reporting business income and business deductions. Business income can be the money we make, revenue, for selling our services or selling merchandise, inventory, products. Keeping in mind that the sales price is not included in revenue. What's in revenue is the gross profit from those sales. And if you remember, the calculation of gross profit is the sales or net sales minusing out the cost of goods sold. Again, that equals gross profit. That now is part of this total revenue right here. We're going to see that most times income is going to be taxable. You cannot exclude it unless there's an exception, or you cannot postpone reporting that to a future year unless you meet an exception. For business deductions, they have to be reasonable in amount, not extravagant. Now that's somewhat subjective depending upon the station or the type of business you're in. What may be extravagant to you is something maybe necessary for my business based upon the type of customers or clients I deal with. Ordinary and necessary is really, I think, misleading, but have been developed to be a little bit more liberal interpretation over the years through court cases and revenue rulings. Here they use the word cost that's conducive to helping you run your business, making it more efficient, more effective, and not necessarily something common or really required, although this term is specifically mentioned in the law. So why don't we take a look at the actual law by going to a web page that has a listing of all the so-called Internal Revenue Code, IRC, and the specific section we're dealing with is section 162 for business expenses. The site that has the Internal Revenue Code is not necessarily the government, but here Cornell University's law school. And they organize tax laws by code number, section number. See this symbol right here? This is section. So tax professionals don't have to say the term trade or business expenses. They just say section 162. And here's that ordinary and necessary terminology. This section is quite long. You can see how detailed it is. And we'll cover some of the detail here in chapter number 1. So you don't have to read the specific law and try to interpret it. Okay, so that's the Internal Revenue Code section 162 where these terms come from. So what's reasonable? We have an example. Rick has a business and he hires his brother Ben and pays Ben $45,000 a year. But the same type of work Ben does, other employees get paid only $30,000. So how much do you think Rick can deduct when he pays Ben the $45,000? The so-called arm's length transaction amount, what you would pay a unrelated person, would be only 30. So how about that extra 15? Can Rick deduct it? Well, here according to the next slide, it's more of a personal gift Rick is giving to Ben, and not necessarily compensation for work Ben has done. And when you pay a personal gift, you can't deduct that. Okay, so just $30,000 is deductible. Some other rules regarding deducting expenses. If the cost being paid is against public policy, in other words, if the government fines you, you're paying a penalty Now, not a business or someone penalizing you, but the government. That fine is non-deductible. If you pay a bribe, that's illegal. You can't deduct that. Now, lobbying costs and political contributions could be legal within certain limits under other laws. But for tax laws, it says that you can't deduct them. Here's another category of expenses that you cannot deduct. If you incur costs related to earning tax-free income, that cost cannot be deducted. So the example they give here is we borrow money, let's say from a bank, and we have to pay interest on that loan. And the proceeds of the loan we use to invest in tax-free municipal bonds. So because the proceeds were used to earn tax-free income, the cost for that proceeds, the interest we pay, should not be deductible. Something similar here, we buy life insurance on a key employee, and the cost of paying for this insurance is the premium here. We have to pay the insurance company. The general rule is life insurance proceeds are tax-free. So when you pay the cost to buy that life insurance as premium, the premium cost is non-deductible. Other categories of what's not deductible, at least right away, is if the cost benefits a future period, and we have to treat that cost not as a so-called expense or revenue expenditure, but treat it as an asset or capitalized expenditure. Personal costs generally are not deductible, especially for business purposes. Some personal expenditures can be deductible, so-called itemized deductions, which we'll see examples in a few slides from now. And Tax Cut and Job Act has changed the rules here for deducting business interests. So for capital expenditures, if the cost is going to benefit a future year, then you have to treat it as an asset and deduct it over the period in which it benefits. Part of it this year, part of it next year, part of it maybe in a year after that. That's the general rule, but there's always exceptions to general rule. Here it says that if the benefit is for a less than 12-month period and that the benefit doesn't go beyond the end of next year. So if I have a cost incurred in 2018 and that here ends during the 2019 period, that's going to be less than 12 months. But if the benefit extends on to 2020, that's beyond 12 months. That's going to be beyond the end of next year. You have to meet those two conditions here with the word and. Yeah. So we have an example here. We have been incurring costs right in the middle of the year for 3 different situations. 10,000 for 10 months of utilities. Okay, so that's less than 12 months. Doesn't go beyond the end of next year. So all of this should be deductible now, assuming Ben's a cash basis taxpayer. 12,000 for insurance, more than 12 months. So only 6 months worth for this year can be deducted, and then 12 months for next year and the rest for the year after that. 8 months of interest. Oh, let's go back to the previous slide. Here it says that the 12-month rule doesn't apply to interest, so you have to deduct it for the period in which it benefits. No 12-month exception here. So here we're paying it for 8 months. So 6 more months for the current year. 6/8 of this should be deducted this year, and then 2 months worth deducted next year, even though you're paying it up front. Yeah. So here's the calculation for those 3 situations. So how about if you incur costs for personal benefit versus business benefit? Maybe the better term is non-business here, like paying charity and medical. Now there are limits to deducting charity for a business return like a corporation. Most times that type of costs for other businesses pass through to the owners. and deducted as what they call itemized deduction versus a business deduction. Medical costs generally is a itemized deduction, personal in nature. If you have costs that has both personal and business, then we may have to do an allocation. The common one is when you go on a business trip. If the primary purpose, that's the key word here, the main purpose of the trip is business, then the airfare, flying to the mainland or neighbor island, if the main purpose is business, then all of that airfare is deductible. Now for the rest of the cost, like hotels, local transportation, and meals, depends on the day, what you do during that day. Is it business or is it personal? Is it attending that conference, business meeting, or is it sightseeing, visiting relatives? You have to see the amount of business days to allocate the rest of the costs here. And no matter what, if you have business meals, entertainment is eliminated under the Tax Cut and Job Act. Half of the meals, business meals, are deductible. So let's take a look at an example where we have Ben again going to Chicago, and the airfare is $1,200. He spends 3 nights there, $250 per night, $90 per day for meals. And if the primary purpose of going to Chicago is business, he gets to deduct all of this airfare. He gets to deduct 2 of the 3 nights hotel, 2 of the 3-day meals, and take half of that. Remember, 50% is what's deductible for business meals. Now, if the primary purpose was personal, none of this is deductible, the airfare. Just one day for the hotel. 90 times 50% for 1 day of meals. Now, it's not real strict in terms of saying if it's 1 of 3 is business, then the primary purpose is personal. Okay, what is the main reason he's going on this trip? Even if it's just 1 day. If it's business, I would deduct all of this airfare costs. The presumption here is looking just at the days, personal versus business. And it's all or nothing. Okay, that's a presumption.